the corporate acquisition game now is so driven by the leveraged buyout and the so-called, what do they call them? Strategic, yes, strategic. I usually translate that into barnyard language, and and there's so much craziness in price from our viewpoint. Of course, it's very hard for us to do it. The people in the leveraged buyout game who love massive leverage and don't mind high prices, even they are getting nosebleeds. It's hard, and it's not an environment that means that allows Berkshire just to go out and buy a whole lot of companies.
Have we ever made a strategic deal that
we have to wait?
We made a strategic deal that you can remember? Have we ever made a deal that we would have regarded as strategic?
We never had a strategic plan unless you've hidden it from me.
Okay, that answers that.
Our competitors are buying with somebody else's money, and they get part of the upside and take none of the downside.
And they'll
that
leverage
is hard to compete with people like that.
Yeah, they'll leverage it up. They'll make a lot of money if it fails, and they'll make even more money if it succeeds. And that's not our equation.
No.
And that isn't always that way, but it's certainly that way now. It's probably.
It's not in the shareholders' interest that we get to be like everybody else. It is weird that about 99% of the public companies that change hands in terms of control change hands in a sort of auction presided over by an investment banker. And the people that buy are usually just leverage it to the gills, and then if it starts doing a little better, they re-leverage it. And that money is coming out of the charitable endowments and pension plans who are making these highly leveraged investments in all these companies changing hands at very high prices. Sooner or later, this is not going to work perfectly.
Yeah.
And it's going to have an unpleasant episode. And I think we'll be around and in good shape at that time.
There was one fellow who came to me many years ago, and he had a wonderful business. And he had been worried because he had seen a friend of his die, and the problems that arose later when the managers, to some extent, tried to take advantage of the widow, and it became a disaster. So he said he thought about it a lot the previous year, and he decided he didn't want to sell the business to a competitor who would be a logical buyer, because they would fire all of his people, and the CFO that would remain, and all up and down the line, they'd all be the acquirers people. He didn't want to do that to his people. And then he thought, and he didn't want to sell it to a private equity firm because he felt they'd leverage it up. He never liked the leverage that much, and then they'd just resell it later on to somebody, so it would be totally out of control of what he wanted to do. And he wanted to keep running it himself. So he said, Warren, he said, it isn't that you're such a great guy. He says, you're the only one left. So Berkshire will continue to be the only one left in many cases.
We just don't believe in a lot of leverage. I mean, you could have thought junk bonds were wonderful at 15% because they eventually did go to 6%. You would have made a lot of money. But if you owed a lot of money against them in between, you wouldn't have been around for the party at the end. So we believe almost anything can happen in financial markets, and the only way smart people can get clobbered really is through leverage. If you can hold them, you have no real problems. So we have a great aversion to leverage, and we would predict that a very high percentage of the smart people operating in Wall Street at one time or another are likely to get clobbered through the use of leverage. It's the one thing that forces you, or it's one thing that ends or can prevent you from playing out your hand. And all of the hands we enter into look pretty good to us, but you do have to be able to play them out. And the fascinating thing to me is that, just take the junk bond situation. In 2002, you had people with a terrific IQ, tens of thousands of them operating in Wall Street. You had the money was available. they all had a desire to make money. And then you see these extraordinary things happen in markets, and you say to yourself, can these be the same individuals that 2 years later or 2 years earlier were buying these things at prices that were double or triple or quadruple what they sunk to in between? And did they all go on vacation? Did they lose their ability to raise money? No, the money was, Wall Street was awash in money, and it was awash in talent, and yet you get these absolutely extraordinary swings. I mean, it doesn't happen with apartment houses in Omaha or, with McDonald's franchises or farms or something, but it's just astounding what can happen in the marketable securities department. And the big thing you want to do is, at a minimum, you want to protect yourself against that sort of insanity wiping you out, and better yet, you want to be prepared to take advantage of it when it happens.
One thing I think is that I have avoided all my life compensation consultants. To me, it's sort of, I hardly can find the words to express my contempt.
I will say this, if the board hires a compensation consultant after I go, I will come back.
Mad. So I think there's a lot of mumbo jumbo in this field, and I don't see it going away.
Oh, it isn't going to go away.
Yeah.
No, it's going to get worse. I mean, if you look at, the way compensation gets handled, everybody looks at everybody else's proxy statement and says we can't possibly hire a guy that isn't the.
It's ridiculous.
So on, and the human relations department, work for the CEO, come in and suggest a consultant. What consultant is ever going to get another assignment if he says you should pay your CEO below down in the fourth quartile because you're getting a fourth quartile result? I mean, it just, it isn't that the people are evil or anything. It's just the nature of the situation. It produces a result that is not consistent with how representatives of the owners should behave.
It's even worse than that. Capitalism is the golden goose that we all live on, and if people generally get so they have contempt for it because they don't like the pay arrangements and the system, your capitalism may not last as well, and that's like killing the golden goose. So I think the existing system has a lot wrong with it.
I think there is something coming in pretty soon. I may be wrong about this, where companies are going to have to put in their proxy statement the CEO's pay to the average pay or something like that. That isn't going to change anything. I mean,
it won't change a thing.
It won't change a thing, and it'll cost us.
And by the way, it won't get any headlines either. It'll be tucked away.
It'll cost us a lot of money, with 367,000 people employed around the world, and I mean, we'll hope to get something that makes it somewhat simpler so we can use estimates or something of the sort. But to get the median income or whatever, however the rules may read, and
that's what consultants are for, Warren.
Yeah, it's it is human nature that produces this, and I write in this letter to the managers every 2 years. I said the only excuse I won't take on something is that everybody else is doing it. But of course, everybody else is doing it is exactly the rationale for why people did not want to count the cost of stock options as a cost. I mean, it was ridiculous. All these CEOs went to Washington. They got the Senate, I think, to vote 88-9 to say that stock options aren't a cost. And then a few years later, that it became so obvious that they finally put it in, so it was a cost. It reminded me of Galileo or something. I mean, all these guys.
Worse. It was way worse. The Pope behaved better to Galileo than he was.
Well, anyway, I would hope, like I say, somebody, whoever, and it doesn't even have to be, I'm not talking about the current successor or anybody else. I mean, these successors down the line are probably going to have gotten very, very wealthy by the time they're running Berkshire, and the incremental value of wealth gets very close to zero at some point, and there is a chance to use it as a different sort of model. But I don't have any problem if a system is devised that recognizes retained earnings. I've never heard anybody talk about it. At the 20 boards I've been on, or if you and I were partners in a business, and we kept retaining earnings in the business, and I kept having the value to buy a portion of you out at a constant price, you'd say this is idiocy. But of course, that's the way all the option systems are designed, and it's better to be for the CEO and for the consultants, and of course, usually if there's some correlation between what CEOs are paid and what boards are paid. If CEOs were getting paid at the rate that they got paid 50 years ago, adapted to present dollars, director pay would be lower. So it's got all these built-in things that, to some extent, sort of kindle the.
No Berkshire director is in it for the money.
Well, they are. They own a lot of stock, and they bought it in the market just like the shareholder did.
It's a very old-fashioned system.
I looked at one company the other day, and 7 of the directors had never bought a share of stock with their own money. Now they've been given stock, but not one of the. I mean, I didn't say not one. 7 of the directors had never actually bought a share of stock, and there they are, making decisions on who should be CEO and how they should be paid and all that sort of thing. But they've never felt like shelling out a dollar themselves. Now they've been given a lot of stock. It's we're dealing with human nature here, folks, and that what you want is to have a system that works well in spite of how human nature is going to drive it. And we've done awfully well in this country in that respect. I mean, American businesses overall has done very, very well for the Americans generally. But not every aspect of it is exactly what you want to teach your kids.